Yo, hey, what's up, guys? So, yeah, today I wanted to discuss about this strategy. Basically, today I'm going to backtest a strategy. The strategy is based on smart money concepts, and yeah, let's start with it. So, this strategy is I don't know the credit goes to who, but I found my mentor has told me about this strategy, and also I found this strategy in this PDF. This PDF is by this guy called Hanson. You can check him out on Twitter. This is his account. So yeah, in his PDF, he has clearly shown what the strategy is. So yeah, you can see this ICT and Laurels. I think they all get the credits for this. So yeah, basically the strategy goes like this. Mm, so first there is a draw on liquidity. So what we do is basically we mark out the higher time frame liquidity pools, and those could be the the high time frame liquidity pools could be this sell side liquidity or the buy side liquidity. So what does this mean is that there's a lot of stop losses here. So you can see this price coming down and taking all those stop losses, taking all those liquidity. So this is called drawn liquidity. Similarly, on the buy side, there are a lot of stop losses here. These are like equal highs. So there are lot of retail will think that this is a resistance, and they are going to keep their stop losses here. So that's why this is a drawn. When price does like this is called as drawn liquidity. So you can see liquidity can be previous day high, previous day low, previous week high, previous week low, equal high, equal lows. So basically, yeah, those are liquidity pools, and when price goes for those liquidity pools, they are called drawn liquidity. So the first step of the strategy is basically, yeah, it's called the draw on liquidity tool, drawn liquidity of higher time frames. Yeah, and then the second step in of this strategy is basically once we reach the higher time frame liquidity pools, we are expecting a reversal from there. So, for example, let's say this is a liquidity pool here. So price reaches here and we are expecting a reversal from this. So that's what we are expecting price to do. That price is coming here to take all this liquidity and then go to wherever it wants to go. So on the higher time frame, yeah, after it reaches the higher time frame liquidity pools, we are looking for a reversal. So this will be called as the point of interest, right? So the other places for reversal could be the FVG, which is the fair value gap on a higher time frame, right? So this is called as an imbalance or an FVG. Um, so yeah, so basically, once we reach the higher time frame imbalance or the higher time frame liquidity pool, we will start looking for our reversal, and the reversal would be confirmed like this. Basically, it will be reversal would be would be done could be done in two ways. One way is this Quasimodo pattern, which is basically this is on the lower time frame. So once we reach the higher time frame liquidity pool, we immediately need to after that we need to switch on to our lower time frame to spot our entries for the reversal, right? So let's say higher time frames, I would say those would be 4 hour, daily, and weekly, right? And even 1 hour maybe higher time frame, but I'm not very sure because I'm not so experienced. And the lower time frames I would categorize as 15 minute, 5 minute, 4 minute, 3 minute, 2 minute, 1 minute, right? So once we are in the higher time frame point of interest, which is the um, 4 hour fair value gap or the 4 hour all those equal highs or previous day high, previous day lows. Once we are there, we are going to switch from 4 hour chart or the daily chart. From that, we are going to switch over to the 15-minute chart or the 5 minute chart, right? So once we are on this lower time frame chart, which is the 15-minute or 5 minute chart, we are going to look for our entry, and our entry would we are going to enter when price does a Quasimodo pattern. So this is a Quasimodo pattern. Basically, it makes a high, then it makes a low, then it goes makes a higher high, which is kind of like taking the liquidity above this high, and then it breaks the structure, it comes below this, it breaks the structure or change of character, we can say. It comes below this low, and then uh, and then it goes back up into more more than often it would, when it comes down to break the structure like this, it will leave a fair value gap here or imbalance here. And then once the price reaches back to the fair value gap, that's where we enter, and then yeah, boom, it will go down to where we are expecting it to go. So on a bullish case, it looks the inverse, which is basically price comes, makes a low, goes up, makes a lower low, grabbing the liquidity, then breaks the structure, then we enter on the fair value gap. So it's just the total opposite, right? So yeah, this is the candlestick chart for this low time frame view. Uh, but price comes down, takes the liquidity above. There's an immediate break of structure. We call it displacement. There's a sudden price movement, and it leaves a fair value gap. Price comes back into the fair value gap, and that's where we enter, and then boom, it will go down. Yeah, I mean, this is a strategy. It may not happen like 100%. Most likely, I mean, 100%, I'm sure that it won't happen 100% of the time like this. So I don't know what the win rate of this strategy is. We have to figure out during our backtesting. So yeah, basically this is the strategy, and maybe in the next video I will show you some backtesting, right? All right, let's stop this video here. Shall we stop it? I think, yeah. So basically, yeah, we see that consolidation, or we can say that the price is ranging. Basically, whenever price ranges, uh, it is it is it is it is making a lot of liquidity, we can say. It is like generating a lot of liquidity. So price is ranging like this, right? So it is generating a lot of liquidity here in form of stop losses, and also in form of stop losses below. So that is what it means by engineering liquidity. So once it does that, then we look for the higher time frame point of interest, and price moves into the higher time frame point of interest, which could be the imbalance, or which could be order block, or which could be the buy side or sell side liquidities. And then we look for the smart money reversal on the lower time frame. And yeah, from there, we, as I said, we enter. All right, bye guys.